Welcome to the deep dive. Today we are taking a closer look, really plunging into the strategy of a huge industrial player, Stanley Black Decker, the company behind DeWalt, Craftsman, Stanley. This isn't just about Q3 numbers. It's about a massive multi-year strategic overhaul they're in the middle of.
That's exactly it. And our sources today, they're pretty dense earnings call transcripts, the official 10Q filing with the SEC. So our job really is to translate. We want to pull out the key progress points on their big transformation plan and crucially figure out how these, macro pressures, tariffs, softer demand are hitting those ambitious goals.
Right. They keep talking about becoming a world-class branded industrial company. That seems to be the mantra. And the strategy, it looks like it boils down to two core things. A huge cost-cutting program, and really focusing hard on their main brands. Okay, let's try and unpack this.
Yeah, and when we say huge scale, we mean it. This transformation kicked off over 3 years ago, the big financial target they're shooting for. $2 billion in pre-tax run rate cost savings, and they want that locked in by the end of 2025.
$2 billion. That's a massive number. Maybe break down pre-tax run rate cost savings for us. What does that actually mean day to day?
Sure. Think of it less like cash piled up in the bank today and more like permanent changes they've made. Things like streamlining operations, maybe renegotiating supplier contracts, closing down older facilities. Stuff that going forward means $2 billion less in annual expenses. It's about baked-in efficiency.
Okay, got it. So it's future savings locked in now. If $2 billion is the goal for end of 2025, where are they now in Q3?
They're surprisingly close, actually. As of Q3 2025, they've generated about $1.9 billion in those savings since starting back in mid-2022.
Wow, $1.9 billion. That's impressive discipline.
It really is. But, it does make you wonder, have they already grabbed all the low-hanging fruit?
Yeah.
Is that last $100 million going to be significantly tougher to find? That's something to keep an eye on.
Good point. Because hitting that cost number is really just, laying the groundwork for the main event, right? Yeah. The big profitability target. What's their North Star there?
The North Star is definitely adjusted gross margin. They're aiming for 35%. And the timeline for that is hitting it or being very close by the fourth quarter of 2026. Achieving 35% would put them right up there with the best industrial companies globally. And for SWK, historically, that's a pretty significant jump. It shows that shift towards the pro user is working.
Okay, 35% margin by late 2026. And they have these 3 strategic imperatives to get there: activating brands, operational excellence, and accelerating innovation. Let's dig into that first one, activating brands, because it sounds like that's where some really sharp choices were made.
Absolutely. It's a fundamental shift. They're moving away from just, making products and pushing them out, a product-led approach. Now it's much more brand-led, market-back, which means really prioritizing DeWalt, Stanley, and Craftsman. Everything revolves around those 3.
And that investment in DeWalt targeting professionals seems pretty heavy. They mentioned adding nearly 600 trade specialists, field resources over just 2 years. That's a lot of people.
It is a big investment in headcount, yeah. But the source material suggests it pays off quickly. They're talking about typical payback within 12 months. Seems the logic is if you embed people with the pros, understand their needs deeply, you capture that really sticky, high-margin business.
Makes sense. But focusing so hard on some brands means, deprioritizing others, right? And that's where we see the cost of this focus show up.
Exactly. They've taken, a pretty sharp knife to parts of their brand portfolio, basically signaling they're pulling back investment, advertising, you name it, for some well-known brands. In Q3 25, they actually booked a big charge, a $108.4 million pre-tax non-cash impairment charge.
Okay, non-cash impairment charge, in plain English.
It basically means they're writing down the value of those brand names on their accounting books. Specifically, it relates to Lenox, Troy-Bilt, and Irwin. It's an accounting reflection of the strategy. Stop broadly investing in these names. Focus marketing only where they already have a strong niche, like Lenox saw blades or Irwin clamps in certain areas. It frees up money and attention for the big 3.
Got it. So that's imperative 1, brand focus. Now, you mentioned 3 imperatives. The second one, driving operational excellence, wasn't in our initial summary, but sounds crucial. What's that about? Sounds a bit like corporate speak.
Yeah, it can sound like that, but it's actually the engine room for those cost savings we talked about. This is where the $1.9 billion comes from. It involves huge changes in how they actually make and ship products. Things like footprint consolidation, fewer factories, fewer warehouses, big supply chain optimization projects, improving logistics, streamlining how inventory moves globally. It's all about becoming leaner, faster, more efficient, getting the right tool to the right place without waste. That's essential for hitting 35% margin.
Okay, so operational excellence fuels the savings and margin, and that connects to the third one, accelerating innovation. How do engineering and efficiency link up here?
Yeah, they've centralized their engineering teams, and they're pushing hard on something called platforming. Think modular design. They want standardized components, motors, batteries, housings that can be reused across lots of different tools and brands. Fewer unique parts means it's cheaper to design, source, build, and stock everything.
And is it working? Is it making them faster?
Apparently, yes. The numbers year to date in 2025 show a 20% faster product development cycle. That's getting new tools from concept to shelf quicker.
20% faster already. And they see more potential.
Yeah, they're actually targeting another 20% improvement on top of that by 2027. The big goal is to have this platforming approach applied to roughly 2/3 of their whole product lineup by then. That standardization, that platforming, it's seen as absolutely fundamental to reaching that 35% adjusted gross margin target long term. It's not optional for the plan.
All right, so the internal strategy, cost cuts, brand focus, operational excellence, platforming seems well underway. Let's look at the Q3 report card. How did the actual results look? Total revenue was $3.8 billion, flat year over year.
Flat on the top line, yeah. But underneath that, it's interesting. Organically, revenue was actually down 1%. That breaks down into volumes being down 6%, but they offset nearly all of that with pricing, which was up 5%.
So holding revenue flat mostly through price hikes. What about the margins? That's the key metric, right?
Exactly, and that's where you see the progress. Adjusted gross margin hit 31.6% in Q3. That's up 110 basis points. 1.1 percentage points compared to last year. So definite improvement there.
Okay, 31.6%,
Yeah.
getting closer to 35%. Less it by segment. Tools and outdoor versus engineered fastening. There's a bit of a split story there, isn't there?
Very much so. Tools and outdoor, that's T&O, where you find DeWalt, Craftsman, the power tools, outdoor equipment. Organic revenue there actually declined 2%, and they pointed to volume softness. It seems like consumers are pushing back a bit on price increases, and the general DIY market is just kind of subdued.
So maybe fewer homeowners buying that extra drill or saw right now. But within T&O, there was a bright spot.
A huge one. DeWalt, their pro-focused brand. It actually delivered revenue expansion, grew across all its product lines, all regions. That really highlights how the strategy is working. That focus on the professional user is providing resilience even when the consumer side is weaker.
Okay, so T&O is mixed, but the pro side is strong.
Yep.
What about the industrial side? Engineered fastening, CEF?
CEF had a strong quarter. That's the business making things like specialized fasteners for aerospace, high-tech connectors for industry.
Yep.
Organic revenue there grew 5%, and that was mostly volume up 4%. Aerospace was particularly strong, grew over 25% organically. They mentioned a solid backlog there, too, so you see this balance. Strong industrial demand helping offset the softer consumer side.
Right, the diversification helps. Now, looking ahead, they trimmed their full-year adjusted EPS guidance slightly, down to around $4.55 from $4.65. Why the slight dip if margins are improving and savings are coming through?
Good question. They flagged higher than expected production costs and specifically linked them to two things: tariff impacts causing some volume softness, and crucially, the costs tied to shifting their supply chain around. Basically, they're spending a bit more in the short term, particularly in Q4, to get their manufacturing footprint right for 2026 and beyond.
Ah, okay. Spending now to save later. But they kept the cash flow target the same.
Yes, full-year free cash flow target held firm at $600 million. That shows the underlying business is still generating decent cash despite those extra costs.
And that cash flow lets them focus on priorities like investing back in the business and strengthening the balance sheet, right? Getting that debt down.
Exactly. They're targeting a net debt-to-adjusted EBITDA ratio of 2.5 times or less. Getting the balance sheet healthy is the priority. Things like opportunistic share buybacks only come after they hit and sustain that leverage target. Debt reduction first.
Okay, which brings us neatly to maybe the biggest challenge they're tackling. Those tariffs and the huge supply chain pivot it's forcing.
Yeah, the elephant in the room, really. The tariffs are creating ongoing cost pressure. It's why they're doing multiple price increases. There's another one coming in Q4.
But you can only raise prices so much before demand really falls off a cliff, I imagine. So the real fix has to be operational, changing where things are made.
Precisely. They can't just price their way out of it forever. So they're executing this massive plan to cut their reliance on China for goods sold in the U.S. It's a really significant strategic shift in global sourcing.
Give us the specifics on that shift. How big is it?
Okay, so in 2024, roughly 15% of their supply for the US market came from China. The plan is to get that under 10% by the middle of 2026, and then push it even lower to under 5% by the end of 2026. That's a dramatic reduction in just 2 years.
Wow. Moving, what, two-thirds or more of your China to U.S. volume in 2 years? That sounds incredibly complex. What's the main action they're taking to achieve that? And what are the risks right now?
The key action is rapidly moving cordless power tool production out of China and into Mexico. That helps them qualify for USMCA benefits and avoid tariffs. They're also increasing USMCA compliant production generally. The risks, well, short-term disruption, definitely. Quality control during the transition. And, importantly, cost. They're likely running duplicate operations for a while, keeping some China capacity online while the Mexico plants ramp up. That's part of why Q4 costs are higher, and EPS guidance dipped slightly. They're paying that transition cost now.
So they're consciously incurring higher costs now to build a more resilient, tariff-proof, and ultimately lower-cost manufacturing base for the future.
That's the bet. It's essential for hitting that 35% margin goal sustainably. They need to get out from under those tariff pressures long term.
Okay, so Q4 organic revenue might look flat, maybe a bit sluggish because price hikes are fighting against softer consumer volume. But the bigger story is this massive internal rewiring for the long haul.
Exactly. It's a foundational realignment. They're clearly prioritizing long-term value creation. That means disciplined execution on costs and operations, relentless brand focus, and building this much more resilient supply chain. Less exposure to trade volatility seems key.
So wrapping this up, it's a real duality, isn't it? On one hand, you have this company executing an incredibly ambitious internal transformation, $1.9 billion in cost saved, innovation speeding up by 20%, margins climbing towards 32%. That's impressive execution. But on the other hand, they're battling these intense external headwinds tariffs, a shaky consumer market for DIY stuff. The internal progress is clear, but hitting that 35% margin by late 2026 still feels like a stretch if the broader economy doesn't cooperate a bit more.
I think that's fair. The playbook they're running seems sound. They're making tough choices, maybe sacrificing some short-term earnings smoothness for long-term structural health, a stronger balance sheet, a more robust operating model. They're building a company designed to better withstand future economic or geopolitical shocks.
That's a powerful way to think about it, building resilience. And it leaves us with a final thought, perhaps, this massive shift of production, specifically cordless tools from China to Mexico. It's not just numbers on a page, it's factories, jobs, logistics, huge capital investment. If a giant like Stanley Black Decker is making such a rapid, large-scale move to achieve USMCA compliance and dodge tariffs, what could the ripple effects be? What unforeseen consequences might this kind of localized manufacturing shift have on global competition, maybe even the price you pay for pro-grade power tools over the next 5 or 10 years? Something for you to think about.